But before I get into Visa, I want to make a quick note on the pain in the stock market that we've seen in the last couple days. As I'm recording this, the market is about to open here on Monday, and it looks like it's about to open down pretty severely. Here on The Quality Investor, we like buying quality businesses at reasonable prices. So I view these stock market pullbacks as a feature and not a bug. One thing to keep in mind about quality businesses is that despite turmoil in the markets, they always rebound, and they always rebound stronger than what they were before. However, that turmoil in the markets pulls down the price of a quality business just as much as it pulls down the rest of the market. And that, my quality investor viewers, is where that reasonable price comes in. And in fact, at a huge discount sometimes. Some very high quality businesses are about to go on a great sale. For anybody out there that is panicking due to the market sell-off that we have been seeing, keep in mind that those people either do not have the patience or temperament to be in the market in the first place, or are short-term minded speculators and not investors, not long-term investors. Welcome to The Quality Investor. On this channel, I advocate a simple investment philosophy. Buy quality at a reasonable price, and hold on to it. But when you're new to the game, it can be difficult to have that conviction. Like anything in life, it takes time to develop the patience necessary to succeed. And this is especially true in investing. Investing has a seductive allure to it. Pick right on a few stocks and you can become very wealthy quickly. It's also so easy to see all those stories online of traders making one big bet and hitting it big. What many miss though is you actually need quite a bit of upfront capital to make big money. Social media is full of people touting the next 10-bagger or a stock whose price increases 10 times from its current amount. But if you have $1,000 to start, that's $10,000 after a 10-bagger return. Certainly nothing to live large on. So here on The Quality Investor, I focus on building wealth one quality stock at a time. I believe creating a portfolio of high quality businesses and holding on to it is the lowest risk way to build wealth with real unlimited upside. Sure, the stock market can seem risky, but that's in the short term, especially so if you're buying and selling stocks all of the time. At that point, you're speculating instead of investing. But over the long term, I view a portfolio of high quality businesses as an extremely high yielding savings account. But the key to that is holding on to your stocks because there will be downturns and that will absolutely test your resolve. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Today, this video is for those that want to start dipping their toes into the exciting waters of stock picking, but maybe you don't know where to begin. And another caveat to keep in mind is that there is a certain implicit desire in picking your own stocks. That implicit desire is to beat the market, and you must have a high belief in yourself to do so. If you don't want to beat the market, then you have unnecessarily high costs, both in opportunity costs and time costs. Time costs because it takes time to do your own research and pick your own stocks. Opportunity costs because you can simply buy index funds and earn the market return and more money that way. Let's say you have a few $1,000s to invest and you want to start a simple portfolio for the long term. Portfolio with the desire to earn better than market returns, but also let you sleep soundly at night. So today we are discussing 4 foundational stocks for a portfolio. 4 stocks that are exceptional businesses and have high potential to earn better than market returns. I call them foundational for a few reasons. The reasons are this: they are high quality businesses. They have excellent growth potential. They are a fundamental part of the American economy. And there is a high degree of confidence that they will still exist in 20 years. So what is a high quality business? Well, a high quality business has a certain set of qualities. First, it is easy to understand, and I mean in how they make money. For example, it is easy to understand how a toll collector makes money. They collect money from drivers for driving over a certain stretch of road, or how a subscription service works. They earn monthly fees by providing a product or a service. They also have a strong brand, or as Warren Buffett calls it, a share of mind. People know who they are, what they do, and they associate positive feelings with that business. That's why people always look happy in product commercials. They also have strong management. This is tougher to discern, but a good proxy is in how well they allocate capital. The metric that best reflects that is the return on invested capital, or ROIC. Next, we have excellent growth potential. What's the point of owning a stock if it doesn't grow. You may as well put your money into a savings account. Businesses are either growing or shrinking, and there's no in between. So we must look at businesses that have a strong growth profile. This includes a new or emerging industry. The American economy is constantly innovating, and there are always businesses hoping to capitalize. We're an industry with a high amount of white space. White space are areas of growth that are untapped for a business. Think people using cash, which much of the world still does, converting to credit card usage, or possibly entering new markets through expansion. These are the two most organic types of growth. New industries and growing into untapped market typically offer high returns for all competitors in the space. A business fundamental to the American economy means it is ubiquitous in everyday life. It is so ubiquitous that going about your daily routine would seem impossible without these companies. Just look around your daily life and what do you use or just cannot go without? What do you use to pay for things? What software seems to be on most PCs and corporate computers? There was a cybersecurity failure that affected the entire world the other week. Whatever the reason for the failure, that is an indication of a business deeply woven into the economy. And lastly, before we get to the four businesses, it's important to ask, do we believe the business will exist in 20 years? Capitalism is notoriously ruthless, and companies that seem like they'll be around forever can disappear in the blink of an eye. Blockbuster was famously killed off by Netflix, and many more examples abound. If we want to build a strong portfolio of long-term holdings, we need to be confident that those businesses will be around to generate those returns. Paradoxically, businesses and industries where little innovation is required are actually good here. Innovation is the grim reaper for businesses slow to adapt. Businesses with ultra-wide economic moats and favorable economics in their industries should be the focus here. Additionally, do they sell something people need versus just want? That will also ensure longevity. First on the list, we have Procter & Gamble, ticker PG. Procter & Gamble is perhaps the slowest growing business on this list, but they satisfy the other three criteria in spades. Procter & Gamble is a very high quality business. The breadth of their brand portfolio demonstrates how fundamental this business is to the American economy. This supplier of household consumer goods has a very impressive array that touches nearly every part of the household, from baby products such as diapers to toothpaste like Crest, laundry detergent such as Tide and Downy, and basic over-the-counter medicine like NyQuil and Vicks. I would venture to guess nearly every household has some Procter & Gamble product in their cabinet. You can see here that Procter & Gamble has very steady, stable growth over the last 10 years or so. Nothing that blows you away, but what is impressive is the amount of free cash flow that Procter & Gamble generates. One very positive aspect of their business is they're capital light. Much of Procter & Gamble's manufacturing is outsourced so they can focus on brand quality. And you can see that demonstrated here in their capital expenditure versus the amount of operating cash they generate. This leaves a lot of free cash flow left for investors, and you can see the steadily rising adjusted free cash flow down here, adjusted for stock-based compensation per share. They use that free cash flow to pay out a very healthy dividend as well as share buybacks, both of which contribute to the total return for shareholders. And on that total return, you can see it's about 8% over the last 10 years per year. Year to date alone, we're at 16%. And in the last 1 year, we've turned 9.5%. I view Procter & Gamble as a candidate to, at the very least, match the return of the market. And when looking at the quality of business that Procter & Gamble is, you can see that reflected in their margins. They have a very high gross margin at 51% in the last year, which just closed this past June, as well as an increasing operating margin up to 24% this past year alone. Their free cash flow margin is also on the rise, and all of that comes together in the return on invested capital and return on capital employed at a very healthy ROIC of 37% and ROCE of 22.36%. This is a reflection of that capital light nature of their business and how much operating cash they actually generate. Procter & Gamble was the fourth business I chose for this list over other candidates such as Coca-Cola and Johnson & Johnson. The reason for this was, aside from their impressive brand portfolio, I did believe they had a little bit better in terms of long-term growth prospects, as well as providing products that are fundamentally necessary to the running of an everyday household. Procter & Gamble has also demonstrated that longevity that we're looking for. The business itself is 186 years old, founded in 1837. I can easily imagine Procter & Gamble existing for another 20 years. While Procter & Gamble does carry a lot of debt, you can see that they easily can fund themselves via their cash alone. You can see this green bar here is their operating cash, and it clearly outpaces the amount of debt that they're issuing, the blue bar. The company's report does state that they use their operating cash to fund operations as they should, and debt is used mostly for acquisitions and share repurchases. And despite that scary looking amount of $32 billion in debt, much higher than their cash, resulting in a net negative cash, they have a debt equity of 0.64, which is very healthy. Keeping that debt under control will help ensure the longevity of a business. So while Procter & Gamble won't grow at that 20% per year clip, they will keep pace with the market due to their share buybacks, as well as their healthy dividend yield of 2.37%. That will contribute to the overall total return for investors. Visa, ticker V, is the next foundational stock for any long-term portfolio. Visa is a business that grows like clockwork, 10% every single year. It is an extremely well-managed business, and it is an extremely easy business to understand. Visa is essentially a toll collector that collects a transaction fee on every card swipe made on its network, and that network is vast. Visa is the definition of ubiquitous in the American economy, and in fact, the worldwide economy. It's almost impossible to go throughout your day without using a Visa credit card. And the corollary to that is MasterCard. MasterCard is an equally foundational stock in any portfolio, and I believe on the equal of a Visa. But today we're talking about Visa. Visa is another example of a capital light business. You can see that here reflected in their cash flows. They barely have to have any capital outlays to maintain their stranglehold on their market. This results in extremely high cash flows, free cash flows for investors, which they return in the form of an aggressively growing dividend at over 15% in the last 5 years, as well as an aggressive share buyback program at over 2% over the last 10 years. Visa has extremely high margins, an extremely simple business model, and is very good to its investors. Visa's gross margins are routinely in the 80% range, and its operating margins are starting to get up around 70%. They're at 67% right now. It's reasonable to assume that Visa will only become more efficient as time goes on. Visa also has a 45% plus return on capital employed, which is again a reflection of that capital light nature of their business and the fact that they really don't need to reinvest much back into the business to continue its 10% growth. Visa is easily funded by its operating cash. Although they do have some debt, they have a very healthy debt to equity of 0.53. Visa was founded in 1958 as a division of Bank of America for its credit card program and has since become one of the global leaders in credit transactions around the world. It is hard to imagine Visa not being here in 20 years, as they have their fingers in nearly every type of transaction the world participates in these days. And despite a lot of fintech competition coming online in the last 10 to 15 years, Visa has been quick to acquire it or co-opt it to allow Visa branded transactions on their platforms rather than compete against it. Visa is a solid foundational stock that will provide years of benefit to investors. Next on the list, we have Amazon, ticker AMZN. When I was considering adding Amazon to this list, I had this along with two other stocks in play here. Those other two were Google and Apple. While Google dominates search, I ultimately decided that they were not as fundamentally enmeshed within the American economy as either Apple or Amazon. Regarding Apple, however, if you looked at lists like this over the last few years, Apple was typically at the top of these lists. However, I decided to go with Amazon over Apple because I believe Amazon has a better growth prospects for Apple, and they are more entwined with the American economy than Apple is today. Fundamentally, Amazon is an excellent business. Their debt to equity is below 1, they have more cash than they do total debt, and they've grown their revenue by at least 20% over the last 10 years per year. They've also done a great job growing their gross profit, operating income, and of course, their free cash flow. Now, Amazon typically has a lot of capital expenditures compared to the other businesses on this list. And Amazon is not afraid to make giant upfront capital expenditures that may take a few years to pay off. And that was actually one of my hesitations in investing in Amazon initially, until I realized just how fundamentally sound and important this business is to the American economy. The amount of sectors Amazon alone touches is just vast. Everyone, of course, knows their domination of online retail. There is no one even close to Amazon when it comes to that sector. And really, they changed the game when they started offering the Prime delivery service way back in the mid-2000s. I was an early member of that, and at the time, I thought it was amazing that they could do 2-day delivery, and today, you can get some things the same day. Well, they've expanded much more since then. They're involved in the grocery industry with Whole Foods. They compete with Netflix with Prime Video. They're attempting to compete with Tesla with Rivian. Now, they don't own Rivian outright, but they have about a 16% share in Rivian. They're starting to become a big player in advertising for search to rival Google's advertising revenue there. And of course, Amazon was one of the first movers into the cloud space with AWS. And that's what Wall Street really pays attention to with Amazon. They love to see AWS's growth. In the last quarter, they just reported they had 19% year-over-year growth cloud. So Amazon is incredibly entwined with the American economy in general. Buying Amazon stock is almost like buying an ETF of a bunch of different stocks. And we look at their profitability, you can see their gross margin has really increased over time here. And one of the fundamental reasons for that is because 10 years ago, of course, their online retail business was by far, and still is by far, their biggest business. However, their cloud business has grown significantly. Now, the cloud business has much higher margins. And as cloud keeps growing around 15 to 20% year over year, probably for the next couple years, we can expect that growth. These margins are going to get even bigger. Operating margin as well. In retail, margins are razor thin. And that was one thing holding Amazon back maybe 10 years ago. While people viewed it as a tech company, they never got the love of a Google or a Microsoft because they were still a retail company. Well, that has all changed. You can see that their return on invested capital has been bouncing around a little bit, and a lot of that is due to their massive capital expenditures they'll make that still take a few years to pay off. And you can see here that Amazon absolutely dominates in growth in operating cash. I view 3 of Amazon's businesses as their major sources of growth. Of course, their online retail. We've already covered the AWS. They are the number 1 cloud provider in America, but their third is maybe not as appreciated as much as the others. And that is their logistics or their delivery business. If Amazon's logistics business on its own was its own business, it would be bigger than both FedEx and UPS. They have built a vast logistics supply chain. And while that business on its own might represent the largest logistics business in the world, it's still only 23% of Amazon's total business. So there's a lot of growth left there for Amazon. And ultimately, we have to answer the question, will Amazon be here 20 years from now? I think the answer there is a resounding yes. Aside from the vast diversification of their portfolio that seems to work very well together, more and more life is going online, which means more and more online retail. And of course, delivering all those products is going to only grow their logistics business. And Amazon is the number 1 cloud provider, which is only going to continue growing as more businesses move all their data to the cloud. And we're just starting to scratch the surface of what AI is capable. Amazon has done a very good job of positioning themselves for growth in the new modern economy. And they've become so important to the American economy that they were just added to the Dow Jones Industrial earlier this year. And there's no doubt in my mind that this business will be around for the next 20 years. In my view, only one business has been able to rival Amazon in terms of the vastness of its empire, and that is Microsoft. Our final entry on this list, I believe Microsoft is the most foundational stock anybody can have in your portfolio. It is the number 1 stock in my portfolio, and with the recent downswing we've seen in the last couple days in the market, I am absolutely going to be adding more Microsoft to that portfolio. Ever since Satya Nadella took the helm of Microsoft in 2014, Microsoft has been the gold standard of business excellence. They've actually seen increasing revenue growth over the last 10 years. 10.94% compounded annual growth rate 10 years ago. They just grew their business by almost 16% in their latest fiscal year, which just ended in June. They have increased their gross profits at an accelerating pace, their operating income at an accelerating pace, their earnings per share at an accelerating pace. And they pay a very fine dividend that grows like clockwork at 10% per year. Another business with absolutely excellent fundamentals. They have a 0.1 debt to equity ratio, as well as more cash than they have debt. This business is a picture of perfection in my view. And of course, with that all important free cash flow, they are a compounding machine. They have certainly ramped up their capital expenditure though in the last few years. A lot of that is due to their heavy investment in cloud infrastructure. Of forced to compete with AWS, as well as heavy investment in the emerging AI industry. Microsoft aims to be the #1 AI business, and they're investing for that future. Microsoft has an ultra-wide economic moat. They established that decades ago now with their Windows operating system. And of course, the Office software is ubiquitous on virtually all PCs around the world, as well as corporate PCs. Microsoft, of course, owns a vast array of businesses such as LinkedIn, GitHub, and Skype. And of course, they're a major player in gaming with Xbox, as well as cloud with Azure. The company has seen excellent margin growth over the last 10 years. Their most recent gross margin was at 70% at the end of the fiscal year 2024. Excellent growth from 10 years ago, as well as operating margin growth as well, now at 44%. They've grown their free cash flow margin, and they have a growing return on invested capital, now at over 40% at the close of fiscal year 2024. Every metric in Microsoft is dominating right now, and their dividend, they're set to become a dividend aristocrat in the next couple years. That dividend has grown like clockwork, 10% per year over the last 10 years. And I see that to be a very reliable, safe dividend for years to come. Microsoft is easily funded by their operating cash, which is only growing, and they're using it right now to even pay down their debt, as well as to invest heavily in the future with the cloud and AI. Microsoft is very much poised to be a part of this new American economy for years to come. And asking the question, will Microsoft be around 20 years from now? The answer is a resounding yes. They are, in my view, one of the most reliable growth stocks that you can own. Not only that, but a reliable dividend growth stock. I think they'll have no problem beating the S&P 500 in growth. You can see the last 10 years, they've returned 24.8% per year. They only have a 5% return this year after the little crash that we've been seeing here the last few days. But this is such a fundamentally sound business that they're absolutely going to rebound. Every one of their metrics in 2024 grew. The revenue was up 15%, gross profit up 17%, operating income up 23%, earnings per share up nearly 22%, and free cash flow was up 24.5%. None of those are signs of a business that's on the downturn. Under $400 per share is a very reasonable price for Microsoft, and I cannot wait to add more. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.